The Bank of Canada has just reduced their policy rate by another 25 basis points on July 24th. This marks back-to-back rate drops of 25 basis points. So keep in mind, Canada was the first G7 country to reduce their policy rate, and now the first G7 country to do it in consecutive months. We are now sitting at a policy rate of 4.5%, and we've seen a total of 50 basis points in drops. But what does that mean for Canadian real estate, and more specifically, Vancouverites living here in Vancouver? These rate drops sound nice, but it's not really saving you a lot of money at this point yet. Unless you are carrying a lot of debt, such as myself, these 25 basis points equate to $15 a month savings for every $100,000 of lending. So if you had $1 million mortgage, or you're wanting to purchase $1 million property, you put 20% down, you have a remainder of $800,000. The savings that you got today was $120 monthly, which isn't a lot. A lot of people think that these rate adjustments are going to kickstart the economy. There needs to be some major rate reductions before this happens. Yes, compounded, it starts to add up, with back-to-back rate reductions. We're looking at around, on that same example, $800,000 of lending, $240 a month savings, but we need much larger reductions in terms of the policy rate if we're wanting to see some stimulus in the real estate market here in Vancouver and specifically across the country as a whole. Tiff McCallum and the Bank of Canada made their announcement on July 24th regarding their consecutive 25 basis point reduction, and they stated that the rate cut was aimed at stimulating economic activity. Tiff McCallum emphasized that while core inflation is easing gradually, the path of CPI inflation will remain bumpy, with inflation expected to sustainably return to the 2% target by the second half of 2025. From the press conference, there were three key takeaways. Obviously, the first one was the reduction of 25 basis points, bringing that policy rate down to 4.5%. The second one are the economic indicators. The economy is moving slowly. There is subdued interest in the retail space. So this is another attempt to try to jumpstart the economy and bring people back into the marketplace to see that growth that Canada is needing, because these high interest rates that we've been living with for the last couple of years is really killing the economy and is not only killing mortgage holders, but people in the business space as well. The third is inflation forecast. And yes, core inflation numbers are downtrending, but core CPI indicators will continue to be uneven until some point in 2025. So let's connect the dots here and break this down a little bit further. The Bank of Canada is wanting to stay between this 2 to 3% CPI inflationary number. That is where we are going to be happy. This is where we're going to continue to see reductions in rates if we can stick between this 2.3% inflationary number. The June data came in below the 2.8% prediction of what those inflationary numbers were going to look like. It came in at 2.7, which really facilitated the rate drop today. Before we got those inflation numbers last week, there was about a 60% chance for a rate reduction on July 24th. When that 2.7% number came in, it all but foretold the reduction that we saw on July 24th. The Bank of Canada is wanting to stay between that 2 to 3% CPI inflationary percentage, but the problem here is housing is included in those numbers. So housing has been making our targets that much harder to come to terms with, because without the housing numbers, we would be really doing well with our inflationary numbers and the benchmarks that the Bank of Canada wants to stay between. But because of housing and the elevated cost of Canadian debt, that is what's been making things very tricky for the Bank of Canada to maneuver around. We are all projecting in the marketplace that we need much stronger rate reductions to help with those inflationary numbers. These small 25 basis points aren't going to do much. And if they are really wanting to tackle these CPI numbers, they need to do bigger drops, because they will see better inflationary numbers if they can bring these debt levels down when it comes to mortgages and housing here across Canada, and obviously here in Vancouver as well. For those of you at home wondering what CPI is, a consumer price index, how it affects economics in Canada and housing, I'm going to bring it up on screen here so that you all get a little bit of a Coles Notes understanding of how this works and why this 2 to 3% inflation CPI number is so important. So the goods and services in the CPI basket and consumer price indexing is based off of 8 factors, and those 8 major components are food, shelter, household operations, furnishings and equipment, clothing and footwear, transportation, health and personal care, recreation, education and reading, and alcoholic beverages, tobacco products, and recreational cannabis. So what the Bank of Canada does when it looks at this CPI data is they'll look at, for example, housing. How much was the average home last year? How much was the average price point of footwear last year in comparison to today's date and age? And that's where they can come up with these numbers. They don't want to see footwear and housing and alcohol being increased by more than that 2 to 3% ratio. If we're exceeding that 3%, inflation is starting to run away. So we're finally getting under that 3%. We're finally getting and staying within that 2 to 3% buffer. But because housing makes up about a third of this calculation, it's been really hard to contain it because of the housing costs have gone so extremely high. And part of those housing costs aren't just, the property pricing, but it's your mortgage, your strata fees, your interest, things of that nature. So the problem here with the housing sector is that it makes up about a third of this calculation. And because it's not just registered on property price point, it looks on your mortgage, your rent, your property taxes. Because these components have been going up so high over the last couple of years, it's been really hard to maintain this 2 to 3% buffer. So if they can make some more significant drops, it's going to help with the CPI data, and it's going to save you as a consumer a lot more money as well. The real estate market across Canada as a whole, minus Alberta, has been stagnating for quite some time. The Greater Toronto area, the condo market there, for example, has been hit very, very hard. The market here in Vancouver is extremely, extremely sleepy. We've seen the most amount of inventory in 4 years, and despite the influx of about 1.2 million newcomers coming to Canada, it hasn't been enough to pick up this inventory, which suggests that maybe we've hit a ceiling when it comes to property pricing. In specific areas in and around Vancouver, as some of my previous market update videos have stated, we are still nearing all-time highs, but we haven't been able to really break out, especially those condo and townhouse markets. We've stayed stagnant in those property pricing for about 6 years, despite the influx of newcomers that are coming to the country. And we know that the cost of borrowing is so much, so it's hard for people to operate when the pricing is high and the cost of borrowing is high as well. We do have a weakening job market as well. The unemployment rate in Canada is sitting at 6.4%, which is up from 5.4% of the year previous. Yes, we are below the average, just over 8%, but we are having some factors here that are going to be quite concerning unless the Bank of Canada and the government, frankly, can do some things to try to stimulate some growth, create jobs, and help get us out of these inflationary measures and these economic hard times that we've seen essentially since COVID. Whether you rent or someone who owns properties, the rent decisions that were made by the Bank of Canada affect both parties. We can see that over the last 12 months, rents have essentially stayed the same too, so they've maybe maximized as well. I have a couple rental properties here in Vancouver, and I've noticed that there's been a big lack in terms of viewership when it comes to looking at rental properties, and the pricing isn't as sharp as it was when I was looking at tenants on the year before. So we've seen a lag a little bit when it comes to rentals, and when it comes to new construction projects as well. Developers are starting to really hurt. I know that there's some developers for the first time in decades that they are now incentivizing and getting realtors into the mix with their own sales staff to help promote some of these projects because they are not selling. Despite all this influx of 1.2 million newcomers to Canada, property and products are not being picked up, and that inventory crunch is an issue. If you're a renter, this is good news. Obviously, if there's high inventory numbers and there's a lot of selection out there, rents will start to come down, property pricing will come down. If property pricing comes down as well, the landlords don't need to look at their bottom line as much, and rents can be adjusted as well. So there is an impact whether you're a renter or a landlord when it comes to what the Bank of Canada is doing with their policy rates. When we look at the growth of the economy and how many jobs were created in June, there was only 10,000 jobs created when usually we see around 30,000 jobs created across the country. So, a third of jobs being cut out of the job market is really putting into focus here these holes in our economy as a whole. So these are things that we're going to have to keep track of in the next couple months. And like I said, the stimulus and stimulation that we need from more rate cuts is really what's needed to help bolster the economy and get more Canadians back to work. So what is this going to look like across the real estate market, across Canada, and specifically here in Vancouver? Tiff McCallum did hint that there could be more rate drops coming, one possibly in September. I was reading one commentator, they're pricing in about about a 50% chance of a rate reduction, probably 25 basis points again in September, and possibly another one by the end of the year. Most economists have stated that they believe that Canada would drop 1 full percentage point by the end of the year. So we're going to have to see how that moves forward. It is a welcome sign that they did cut rates today, just because we really needed to have some relief. If they didn't do something today, I think the remainder of 2024 could have been quite disastrous, not only for the housing market, but for Canada as a whole. People are needing a break. We also understand that when we start to get some of these consecutive rate drops, we know more are coming down the pipeline. So that can help people with their future planning as well. I think it's still going to take another minimum 50 basis points to really get buyers excited about the real estate markets, especially in the bigger metropolitan areas like Toronto and Vancouver. There's a lot of inventory. There are good deals to be had out there as a buyer, but it's going to take a little bit more for these buyers to get off the shelf and pick up this inventory. So if we look at a projection of a possible rate reduction in September and a possible rate reduction in December, we're right around Christmas in the new year. That's likely not going to converge until perhaps a strong spring market of next year. And by then, there might be another 1 or 2 rate reductions by spring. So I don't think there's going to be a big drop off, but I think it's going to be pretty steady here unless they do another one in September, which could maybe heat up the spring market. But I forecast that it's going to be status quo with the market, buyer market conditions, and then moving forward, getting ready for a strong spring market in 2025. In any case, my name is Kyle Mark, your Vancouver realtor, and whether you're looking to buy, sell, invest, or relocate to my beautiful city of Vancouver, make sure you book that strategy call with me. It's in the description below, and I'll see you on the next one.